Lately in my previous videos, I've been opening up and teaching more regarding time, and this video is going to be no different because I'm going to teach you an opening price you've never heard before. With my previous videos regarding my London and New York blueprint range, you're going to be able to pair this opening price to know where the market's in a true premium or a true discount. And with this approach alone, it's not just helped me make money from these markets, it's actually helped me not lose money from these markets as well. And by the end of this video, you're going to have so much clarity regarding the markets and knowing exactly how you should be entering, why you should be entering, and when you should be entering using my blueprint ranges and using the new opening price I'm going to introduce you to. So with all of that being said, let's get into this video. First portion of this video, I'm going to teach you what's actually being taught. So why is this opening price that I'm going to tell you about? How is it important and why does it tie into my time-based ranges? And why on earth do these time-based ranges actually work within the market? Because I've taught you the ranges and a lot of you are sending me your successful trades, getting payouts and catching really good moves within the market. But you're confused in understanding why does it actually work. So I'm going to teach you that right now. Trading is all based off before the markets went electronic. So before electronic trading, it was the open outcry period. So within the open outcry period, there were certain levels, areas, and timings within the market that people would call up, put in orders within the market, and where orders needed to be paired. Exactly the same thing is done when the markets are electronic right now. Everything is the same. From that period to now, the markets are still following the same rules and the same concepts. This is where most of ICT's teachings are coming from, regarding fair value gaps, efficient delivery, and inefficient delivery. This is where he thought of the concept of the market needs to be efficient. If it creates an inefficiency, it needs to be rebalanced. And this is where a few things should be clicking for you right now regarding ICT's concepts. Most of his teachings are all based off the open outcry period. And if you go through his previous teachings back to 2016, you'll be able to hear him talk about the open outcry period and how it is affecting the markets right now. Nothing has really changed from the open outcry period to now. Obviously, the markets are electronic. They're moving very quickly nowadays. You can just press a few buttons and be in and out of the market. But this is exactly where my time-based ranges and a special opening price that I'm going to tell you about right now come into play, giving you a high probability setup. So the range we are going to focus on is from 812 to 912. And I know a lot of you are asking, why is he focusing on 812 to 912? This is not real. This will work within the market. Before you just jump to conclusions, just backtest this range, see if it actually repeats within the market, provides a trading setup before you write your comment. But now, why does this range have an importance to the market? As we were speaking about before the markets were electronic, it was the open outcry period. So this is where nothing was really, you could press a button and you could put in an order within the market. Nowadays, you can just press a few buttons and place an order. But we had ranges within the market where orders needed to be paired at an institutional level. So right now, we have high frequency algorithms and banking algorithms that are pairing orders for them at a much faster speed. So we have a time cycle within the market. So there is a bigger cycle that forms every single day. So before I even get into that, I just wanted to speak about where the thesis of these time-based ranges even come into play. So every single day, there's going to be a daily candle, correct? Within this daily candle, there's going to be instructions that the market follows. So the open high low close or the open low high close is already fixed for the day. The market knows exactly where the high is going to form, the low is going to form. It's not forming this randomly. This is set weeks and months in advance of the day you're about to trade. So if you're about to trade the 15th of September 2025, this high and the low of this daily candle might have been made 6 months in advance. So with that understanding, you can know, okay, nothing is random within these markets. Everything is predetermined. If everything is predetermined, then there's a cycle and a macro that the algorithm needs to follow. And I'm not talking about the basic macros that ICT is taught. I'm talking about macros within the market that actually repeat. So a macro is just a short base of instructions that goes on within the market. So within the market, there's going to be time cycles. So everyone knows about the generic Asia, London, New York, but those aren't a real cycle that the market's referencing to. If they were a real cycle, don't you think everyone would be able to make money easily? Exactly. They're not real cycles within the market. They were just made to help people understand the markets easier, quote unquote. So every single day, there's going to be ranges and time cycles that form and build up this whole daily candle.
And these are going to be larger ranges with smaller fractals inside of them. And these fractals is where the 812 and 912 range comes into play. So this is a small fractal of a lot larger fractals within the market. And now if you studied ICT's concept, your brain should be clicking. So this is what he meant by everything is fractal. Exactly. The market has large ranges that break down into smaller ranges, and they're all a fractal of each other. And this is where time cycles and cycles within the market come into play. So if I'm going too fast, or if you have any questions that are popping up, to make sure to leave them in the comments. I will be able to help you. So 812 to 912 is my range, Eastern Standard Time. So this is where we are looking for liquidity to be taken above and below the marketplace. So we have liquidity resting above this high and liquidity resting below this low. This is the easiest way for you to trade it, and how I trade it. I'm only looking for a reversal and a retracement out of this high. So say, for example, the market takes out this high. I'm looking for a breakdown for it to trade lower. Exact same scenario is done if we take out the low. I'm looking for the market to push to the upside. But I hope this is making sense. So we have a daily candle that's printed every single day. Within this daily candle, there's going to be cycles and things that the market has to do to create the high and low of a session, high and low of the day. And there's going to be even more cycles before the 9:30 open that market needs to pair orders from. And as you've also understood my blueprint range, I'm going to introduce you to an opening price, which is going to show you where the market's actually in a premium and actually in a discount. So this is going to help you buy and sell above the range high and below the range low as well. The opening price we're going to focus on is 8:20 a.m. on New York time. So why is 8:20 important? Everyone maps out 8:30. Why is 8:30 important? Well, 8:30 has no bearing to the market at all. That's basically where the news embargo lifts. So if we have news at 8:30, that's basically where it's going to lift and news are going to come into the market. But with going back to open outcry period and what's going on electronically within the market, 8:30 really has no benefit to understanding if the market's in a premium or a discount, because there's no real logic to using that. The only thing that is behind 8:30 is understanding that a news embargo lifts and you can just use it as an opening price. However, looking back to it with a real method of what's going on within the market within time cycles, 8:20 is the real opening price. So why is 8:20 important within the market? Well, 8:20 a.m. is the bond pit open. So in Chicago time, because you're trading the Chicago Mercantile Exchange. However, we're focusing only on New York open, so New York time. So 8:20 is all on New York time. The bond market sets the tone for the rates and the risk. And when those pits opened, this is where big money stepped in, or people that wanted to put large orders into the market. The market needed to stay efficient, so for every buyer, there had to be a seller. So price discovery was created at 8:20. So this is where the market would find a premium and a discount. This is also where ICT got its concepts of a opening price from. Have you ever wondered why on earth ICT spoke about midnight open being a opening price for the day? If the market's above it, why is that in a premium? If the market's below it, why is that automatically in a discount? Well, this is where the logic stems from, understanding what used to go on in the open outcry period. And now you can see the 8:20 opening price. This is where my blueprint range ties into place. From 8:12 to 9:12, you can understand that this is not random. This ties in together with a time cycle. So a lot of people in the previous video, they probably found it a bit too advanced for them. They were like, no, this doesn't work. I don't like this. Well, it doesn't work because you've not tried it, for number one. And number two, you just simply can't accept that something might repeat within the market like this. So 8:20 a.m. is going to be your opening price. And then we have our range from 8:12 to 9:12. So we're going to just put all of this in a box right now. So you're going to map out the 5-minute candle. So the 5-minute candle's opening price, if it's a bullish or bearish candle, you're going to draw this out in time. If the market's above this, this is going to be a premium. If the market's below this, this is going to be a discount. Okay? And then we have the range, 8:12 to 9:12 on New York time. You're basically looking for ideal selling setups when the market is above this range. So it takes out the high of the range. so the buy side liquidity, which is resting above the range. This is where you're looking to target the opposing end, so the discount of the range or the low of the range. But what you can't do is buy this market if it's above 820, and you can't sell this market if it's below 820. And then you need to use the logic of how it's going to be high probability. So if it's above 820, above the range, then you're looking for a breakdown to trade into the sell side liquidity. If it's below the range and we're taking out 820, so we're taking out the range low and we're below 820, we're in a discount. So this is where you can buy the market. And that's the framework that you're going to use using this market. You don't need a daily bias for these ranges. You can just focus on them purely mechanically. But if you do have the daily candle in mind, then obviously it's going to give you a higher probability setup. For example, if the daily candle is bullish and the market wants to trade higher, you have a range and the market's below the opening price. So here we trade below, we trade into a discount. So obviously this is going to be more optimal to buy and look for the upside to trade into the buy side liquidity. But this is where I taught you the understandings behind the range. I am going to dive a lot deeper into this in 2026, so make sure you stay tuned for that. But we are going to move on to the charts. But hopefully this made sense within the logic. So 812 to 912 is a small range within a higher fractal within the market. 820 is an opening price, which shows you real premium and discount being made within the market, and why I don't use 830, because it has no bearing to the market. If you refer back to 820, you can see it actually has some bearing to the market and why it actually shows you premium and discount levels. I'm going to say this quote unquote because we are retail traders. Can't of course see premium discount to a level that most institutions and high frequency interbank traders can, but this is where we can have a small edge with us. So now we are going to move on to the chart, and I'm going to break this down into a bit more detail, bringing it all together. Okay, so now let's break down the price action from yesterday. You can see above this high, we have our range, we have buy side liquidity, and below this low, we have sell side liquidity. So with the Dow Jones, we actually made an SMT divergence. So you can see at the 930 open, this is where we pushed higher and made an SMT with Dow. So Dow traded above this high and took out the liquidity above the range. So then what happened? We traded above 820's opening price. So now the market's in a premium. Look how this candle reacts to this opening price. Trades into it, trades into this OB, and then sells away. So this was a selling opportunity. Let's move on to the 1 minute time frame. This is the 5 minute time frame. On the 1 minute time frame, you can see this is the high that we took out, made an SMT divergence. This red line represents 820's opening price. So anything above this is a premium, anything below this is a discount. Now look what happens. Market closes below this up close candle. Once we close below this up close candle, what does this represent? This represents a change in delivery. What can you do from this point? You can look for a selling opportunity. So the market then closes below these up close candles. This is valid to sell, looking for the downside. So this is where we have our selling opportunity. Stop loss will go above this high. Why does it go above that high? This is because we have made an SMT divergence. And this is where we have a 1 to 2 trading setup, and we get around 40 points from this trade. And you can see very simple trading and focusing on the premium and discount that's being offered within the market, the liquidity that's being offered, and you can see the entry as well. Confirmation is a change in delivery. Once it closes below, we can look for a selling opportunity. The day I'm recording this video is on the 17th of September, so this was only yesterday. You can see 16th of September. Market takes out the high, makes an SMT closure below here, look for a selling opportunity, you get the short and trades into the sell side liquidity, and then using the opening price to show you if the market's at a premium or a discount. And look how the market actually reacts to this opening price. Just pokes above it, and this candle just tags it. Look how it just tags it. Stops there right on the dot and then moves away. So let's go over another example of this understanding. So now let's go over the 12th of September. You can see this is where we have our range, liquidity above the range, liquidity below the range. Just look how the market actually reacts at these levels. It's hilarious. It makes me laugh because people watch this video and be like, nope, doesn't work. I'm not going to look at it. I'm going to focus on something completely random within the market. It just makes me laugh. But those of you that actually want to study, you'll be able to see what's actually going on. Sometimes it's going to happen too quickly. Sometimes it's going to run into the drawn liquidity. You can't do much because of that, because the market's programmed to run for these levels. So look how this opening price opens. 820. This is the open 5-minute time frame. Mark this out. Price trades above it. Premium. Premium takes out the liquidity. Now we can move on to the lower time frame. We can move on to the 1-minute chart. Very choppy market, but still delivering the model. Closure below this up close candle, representing a change in the state of delivery. We are looking for the downside. So now we can look for the sell side liquidity below the range, as long as the market's above the opening price. This poke above, this shows us the market's coming back to a premium. Stop loss above this high, and we can aim for the selling setup, which is a 1 to 3, and we trade into the sell side liquidity. Very simple trading. I'm not saying it's easy, but if you follow the steps of the model and understanding the logics behind it, you will see profitability long term. And you can see, take out the high, we're targeting the low. As soon as the market takes out low, it goes on about its day. So this is a small piece that you want to get from the pie. Once you take it, you can go on with the rest of your day. You don't need to watch the markets all day long. I've literally just cut your learning curve in half. I've told you exactly what to look for, when you should look for it, and what you should be looking for as well. And one more example that we are going to go over. So we have our range, we have the liquidity, which is above the marketplace right here, and we have the liquidity, which is below the marketplace. So we are just looking for the downside on this market. However, you can see market change in delivery, closure below here. This is exactly where we can sell because the market's above a premium. So we're above the opening price, this red line, and we can aim for the downside. So down here, this is a 1 to 8 trading setup. Over here is a 1 to 4. So you need to understand where is the logical areas that you can take profit. If you entered here, you obviously have a good risk to reward on this position. This is where you can get out. If you're looking for the whole low, you need to understand this is a 1 to 8 position that you're going for. Either you take a losing trade this day, or the model doesn't form and you don't trade it. But this is the logic behind what you are looking for. So market takes out the high, we're above the opening price. But not only that, I just want to show you, look how the market's reacting at this opening price. Above it, premium, below it, discount. It's just repelling away. Taps it, flies away. So this was an introduction to the opening price, how you can use it for the New York session with my blueprint range. And if you do have any questions or want to learn more, obviously I go a lot deeper into the understanding of this within my Blueprint Academy, but that's mainly made for people who want to learn about the markets in a lot more detail and learn about why I'm speaking about these time cycles in particular and what is the actual time cycles I am focusing on. I've just shed light on a few of them and you can see the success a lot of you guys have had. I will be having an interview with one of my students in the coming weeks who has actually graduated from the academy and he's doing well. He's an independent trader and I'll be showing you the payouts and everything he has accumulated. But if you are interested in joining the academy and learning more about this, you can just go into the first link in the description and then me and you will have an interview just to see if I can get you to the point you want to be and if the academy is a right fit. But with all that being said, I hope you did find this video insightful. If you do have any questions, make sure to leave them in the comments down below. And remember, I'm rooting for you and I hope you have a good rest of your day.